Welcome to Moffat on Money. I'm Clay Moffat, and today we're giving just a brief update on the market. Haven't done this in a while. Try to get them started up again. There's just so much going on in the market, and it's such an unusual market. There's usually a fair amount to talk about. So today, the past several weeks, seeing all the activity in the market, my opinion, they're struggling to find reality. If the news is good, the markets drop because there's less chance that the Federal Reserve will cut rates and reinitiate quantitative easing, free money, giving out free money. They're addicted to it. It's, I describe it like a crack hoe. Everything pales in comparison. They just are desperate for this free money. The market rises if the news is bad, thinking that the chances for the free money are increased, that quantitative easing will once again be started up, and that interest rates will be cut. It's just absolutely ridiculous. It's gotten to the point where the best case scenario for the markets, for the stock market, is a recession. If we started in the recession, the market would probably go to the moon. Now, is recession coming? Kind of, the topic kind of begs the question here. Let's take a look at something. It's called the near-term forward spread. It's basically the implied yield on 3-month T-bill forwards, 18-month forwards, which a forward is simply the market's estimate of what interest rates will be in that time. So 18 months from now, the rate that the market estimates the 3-month treasury bill will be minus today's 3-month treasury bill. So you get this spread. And what you see here, this graph, is a plot of that spread. And you'll notice a few interesting and relatively consistent features. Now, this chart goes from 1996 through to, today. The data is probably as of last week. And you'll notice that whenever this spread, this near-term forward spread drops below zero, that there is a recession that follows shortly after. These pink bars are periods of recession. You'll remember the recession after 9/11, the subprime crisis recession, the COVID recession. Okay. Now, if you look at it today, well, here we are. The deepest negative spread that it's had since the 1990s. That's a pretty strong indication that a recession is coming. In fact, this index is actually the Federal Reserve's favorite recession predictor. It's highly accurate, it's highly consistent. Will it be wrong this time? I sincerely doubt it. There's just a lot that seem to indicate that the economy is slowing. Some people, 30-40% of the population, think we're already in a recession. Now, looking back on history, and I'm a little bit of a history bug. Past is often prologue. History has kind of a way of repeating itself. I'm sure you've heard that cliche. And I believe it does. I believe there's almost like a cycle of life where people end up repeating certain errors of prior generations. This is, if you've ever read the book, The Fourth Turning, it goes into a lot of detail about this. But the idea is that roughly every 80 years, there is a repeating of the attitudes in people, in society. And these have relatively consistent effects. So I love history. I think it's insightful, though not always a perfect predictor. But I look at the subprime crisis. Now, we've had a little bit of a banking crisis, and a lot of people think the banking crisis is over. Well, if you remember back to the subprime crisis when Bear Stearns collapsed, after Morgan purchased it, there was this quiet period of about 4 months until July the 11th, 2008, when Indy Mac folded quickly. The seventh largest mortgage bank in the US just went belly up overnight. So are we, in a repeating cycle of history? We'll kind of have to wait to find out, but there's still a lot out there to be concerned with. The banking crisis is not over. Morgan's CEO Diamond said that just the other day that we are in a vicious cycle as far as banking. And he was alluding to this same effect, that banks are not out of the woods, that there is a very precarious situation or nature to a lot of banks. We saw the study a couple of weeks ago came out and said that there are over 190 banks in the same position as SVB was. We know that bank runs continue. Last week, $126 billion ran from the banks into money markets, into Bitcoin, into treasuries, whatever. The week before, it was 67 billion, 63 billion. So there is currently a huge outflow of funds from banks. People are trying to capture some of these higher rates, and the banks have the short duration liabilities, the long duration assets, but when they bought those assets, they were very low yielding and they locked in those yields for a long time. So banks have it's really almost impossible for banks to increase the rates on their deposits for a lot of them. So the inflation is taking its toll. The attempted effect to moderate inflation is taking its toll. Speaking of inflation, the Federal Reserve has a site that predicts the next release of inflation. It's called Inflation Now, and it's run by the Cleveland branch of the Federal Reserve. Here's their website, Federal Reserve Bank of Cleveland up there, Inflation Nowcasting. So if we scroll down, it gives a month by month change. Now, April is just the results for the current month. What we're really interested in is March 23, which will be the next release. That'll be the one that the market reacts to. So if we scroll down a little bit more, we get the year over year change. And this shows, based on the data that the Cleveland Fed is collecting, that CPI will come in at about 5.2%. Now, this is down from last month's 6%. So the market will probably cheer this because there's a better chance that the Fed quits hiking, reduces its rates. There's less pressure on the Fed to continue the high rates. But what they probably will ignore is this core CPI. Now, the core CPI takes the regular CPI. The CPI, Consumer Price Index, is the major inflation index that most people talk about when they talk about the inflation rate. The core CPI is a less known index, but it's a more important index because the Fed pays attention to it, not CPI so much. The core CPI takes the regular CPI and takes out energy and food, which are fairly volatile components. The price vibrates a lot. So the Fed's really interested in what the steady inflation rate is, and they believe that core CPI better reflects that. Now, if you look, core is at 5.6, 5.7, which is up from last month's, which was up from the previous months. So for the index that the Federal Reserve actually cares about, inflation is still increasing. This is not an encouragement to them to cut rates. This is not even an encouragement to them to pause hiking rates. In fact, the Cleveland president said the other day that the Fed will continue hiking rates. 2 days ago, the Fed will continue hiking rates. Now, what's that impact on banks and the economy? It's not good. It's not good. But do they have a choice? We talked about this some previously. If the Fed backs off the inflation fight, then we very likely could have an era of hyperinflation, turn into an Argentina or Venezuela. That would obviously have devastating effects on the poor and the middle class. If the Fed continues hiking, then a lot of the financial institutions that made big bets that QE, the low interest rates, would continue forever, will be hurt, like we've seen in some of the banks, SVB, for example, Signature, for example, Deutsche, Credit Suisse. So kind of pick your poison. The chairman of the Fed, Powell, is trying to kind of reinstill an appreciation for risk. I always say that risk and return should always be commensurate. And when they're not, either the market's being manipulated or you're being lied to, which probably there's not a great deal of difference between the two. So what does the Fed do? A lot of things are breaking. Just was looking at the Treasury bill rates, and the 6-month T-bill has dropped from roughly 5.4% to 4.8%. That's a 55, 60 basis point drop in less than a month. That's a flight to safety. People are scared of having their money in stocks or longer term bonds or whatever other assets. And so they buy short term treasuries when they're scared. That's why it's called a flight to safety. And remember, we talked about the teeter-totter a few weeks ago with bonds. As the price of bond goes up, the yield goes down, and vice versa. They're inversely related. So as people buy more and more treasuries, the price, supply and demand, is still a law. Demand goes up, price goes up, hence the yield goes down, which is kind of a fascinating thing because the Fed is trying to hike short-term rates. But the buying pressure on treasuries is forcing their yield down. People don't care about the yield on treasuries. They're not trying to lock in a yield. They're trying to protect their principal. Flight to safety. The fear of a declining economy is a hell of a motivator, especially if that fear is of a severe decline. Once people start not caring about the interest rate they're receiving and just want to protect their downside, they're getting concerned. Now, I love history. Like I said, I refer to it often. I think people in societies repeat themselves over time. There are recurring cycles. And when I think of the current conditions in the economy and the markets today, even the global economy, I am continuously reminded of Rome and the factors that historians attribute to the fall of Rome, the fall of the Roman Empire, the destruction of the world's mightiest empire. And there are 3 or 4 factors that most historians will agree that attend to their collapse and destruction. The first one, internal division. Cliques developed struggling for power and control. They never could get enough power, never enough control. They were literally willing to cut somebody's throat in order to get more power. Do we see that today? Or are the two political sides of the spectrum, or even more, are things getting more angry, more intense, more bitter? I think that's pretty obvious. High inflation. Duh. Now, inflation. How the Romans have inflation? They didn't have a central bank. Well, they kind of did. The government issued the coin. And when Rome was a republic, it issued the denarius, which became kind of the currency of trade for the known world at the time. It had 3.9 grams of silver. And it was stable, it was steady. People felt comfortable using it. It was kind of a store of value. The value of it didn't change. It became the most used money in the world. Now, when Julius Caesar became what was the term? The head of the Roman Republic, became the first emperor. He created the aureus, which was a gold coin, had about 8 grams of gold in it. Both coins were widely accepted, widely used. They became the standards of trade and commerce, and they worked to increase Roman influence and power all over the world. Think reserve currency. Everybody was using the Roman coins. Economic stability reigned for 75 years, even after Caesar's assassination. His handpicked successor, Augustus, maintained the same policies, maintained the stability. So everything kept clicking along until you had Nero. Nero's kind of a famous Roman emperor, borderline or fully insane, I guess I should say. Of course, nowadays he'd probably be considered normal. Who knows? But Nero was obsessed with being popular, and he knew that the people didn't like him or have a lot of respect for him. So he tried buying popularity with spending, giving away free food, free wine, having huge whole weeks of games. Now, what they call games, we call gladiators, watching them slaughter other victims and animals. So that was the entertainment back then. So he literally blinded them from the problems in the economy with free food, free wine, and games, merriment. Now, all of this spending put stress on the treasury. So they needed more money. Well, he didn't really have the power or the ability to increase taxes. They already were pretty high. So what he came up with was coin clipping. He was the first. He basically gathered all the coins in the economy, melted them down, and produced new coins with less gold or silver in them. He gave him more coins with the same gold. So he was able to continue his spending. Each coin had less gold. This was the first inflation, which that's the definition of inflation. You have more money chasing the same amount of goods. So the value of each dollar, of each denarius, of each aureus buys less. Inflation. Now, with Nero offering free food and wine, it had some interesting effects. You had a lot of, for example, farmers and laborers who gave up farming and laboring and moved to Rome to collect the free food and wine. It wasn't available throughout the empire, only in Rome, because they didn't have the logistics and, all that kind of system. So you had people moving to Rome. It was far easier having free food and wine than having to work for it. And this ultimately is the essence of modern Keynesian policy. You devalue the currency and increase government spending. It ends up reducing the value, the wages, the real purchasing power of the working class and their savings. Well, Nero started coin clipping, but his successors fell in love with spending also. Everybody likes to be popular and everybody loves free stuff, even though it's not really free. The aureus ended up being reduced from 8 grams to 7.2. Caracalla reduced it to 6.5. Diocletian reduced it to 5.5 grams per coin, and then 4.5 grams per coin. So the pace of inflation was picking up. Any of that sound familiar? Third main issue with Rome was concurrently, they had a huge wave of immigration, particularly from the Germanic tribes. They had been, conquered and kind of suffered some at the hands of the Roman army. And there was a fascination or interest in the source of this power. So they traveled to Rome and surrounding areas, wanted to see the source of this power. Also the free food and wine sounded good to them. But the large waves of immigrants rejected Roman culture and laws. They wanted to keep their own. So that was a source of conflict and internal destruction. And it helped feed the moral decay. The ruling class was corrupt, greed, lust, everything became expendable to them. And just a play toy to the elite. They got to where they didn't even pay the soldiers, had fewer games, started running out of food. This is the part where free money becomes not so free. while increasing the money supply to fund their wars and government spending resulted in inflation and ultimately an economic crisis, which the emperors attempted to control by spending even more. Ferdinand Lipps, a noted economist, summarizes the process by saying, in what should be a lesson to Keynesian economists, Rome tried to manage their economies. They only succeeded in making things worse. Price and wage controls were passed, but it was like trying to hold back the tide. Rioting, corruption, lawlessness, and mindless mania for speculation and gambling engulfed the empire like a plague. With money so unreliable and debased, speculation in commodities was more attractive than producing them. Speculation in commodities was more attractive than producing them. Bottom line, throughout history, it's almost a repeating pattern. The debasement of the currency, the debasement of values leads to the debasement of society as a whole. Rome could no longer pay its troops. There was no longer any respect for the lack of virtue, the lifestyle of Rome. Nobody was willing to come to their aid. So the Visigoth and Vandals had it made, had a field day, and ultimately sacked Rome. During this time, Constantinople thrived. But a little later, after its rulers started debasing their currency, came the fiscal, the military, the cultural, and the spiritual decline that led to the Dark Ages. Taxation and inflation destroyed the wealth and savings of the people. This led to a system where wealth was acquired only through inheritance and conquest. The royal classes of Europe rose. Meanwhile, the peasants had no upward mobility, nowhere to go, had no savings, no earnings. They existed merely at the whimsy of the ruling class. So let me ask you, does money matter? Does money and do values matter? I think they matter greatly. And that's what we try to do on this channel, is to, offer some insight as to how money and handling of money impacts your life. So that's kind of the overview of the markets, a little bit about history. We're going to, talk more about history, financial fraud, and some other things as we go forward. Apparently, we're getting some requests from people that we love who are interested in those kind of things. So we'll try to do that. Saturday night and in Live and Rambling, we're going to take a look at the lack of a credit union crisis and also how to prepare for the best years of your life. So tune in, subscribe, hit the like button for everything. Don't let Chunk or Tallulah down. Always interested in ideas for future discussion of what's interesting to you, or what questions do you have, or what's confusing to you. Let us know. We'll try to help. Feel free to comment below or DM me at Moffat on Money on Twitter. My time is up. I thank you for yours.